Hi, today I'm going to talk about different types of financial planners, examples of what they might cost, and how they're licensed. Perhaps also the different types of people they might suit. The first planner is the phone planner. Phone planners can work with banks. Largely institutional industry funds use phone planners. You might think of brands like Australian Super, Hester, Cbus, and so on. For example, Cbus historically worked only with members in the construction industry. However, now all the industry super funds are open to anyone who'd like to use them. They are non-for-profit, which means that they generally have lowest fees of all the funds. Roughly for a phone advisor, you'd expect to pay about $300 for each subject you speak about. It might be investments, could be retirement planning, could be insurance, and so on. But it's a very basic type hourly conversation. So that would be $300, regardless of if you had $1 million or $100,000. However, when you put money into the industry super fund, the balance fund, you could expect to pay something like 0.7%, which would be a $700 per annum investment fee. And for $1 million, that would be the same, which is a $7,000 per annum investment fee. And on top of that, if you'd like that phone and planner, that would be $300 for that subject for the hour. The next planner is the bank planner. You know the bank planners at ANZ, CBA, Westpac, NAB. Your local branch will have planners within those branches, and they will be able to offer you a service, many times quite a consistent service, because they follow a step-by-step process when you come into the branch and ask for the planner. You can expect to pay for those planners, for example, maybe $3,000 per annum if you were to go ahead with an ongoing relationship. The funds that they put you into, for example, might cost 2% per annum. So on $100,000, that's $2,000. On $1 million, that's $20,000. But you can expect that you pay similar in the advice fee of $3,000, whether you had $1 million or $100,000. And that's because the bank is making profit out of the funds that the advisor puts you into. And so it can kind of subsidize the advisor's fee. So it reduces that fee a little bit for you in that scenario. The next planner would be a bank. They call them bank aligned. A bank aligned planner, or an institutionally aligned planner, they operate under their own name or their own business name, whatever it is, Christian's Financial Advice, and they'll tell you generally that they're dealing with a license under a bank of sorts. So they might put you into a retail super fund called maybe MLC, which is owned by NAB, or Colonial First State, which is owned by CBA, or they might put you into a North retail super fund, which is owned by AMP, for example. The fees for $100,000, if they do deal with you for $100,000, you've got to expect that they do have fees. It's their own business. They might not be able to deal with someone of that amount of money, but I think they'd be able to start at a similar $3,000 mark, for example. And on the funds, they could probably go a bit lower, 1.5%, because they don't have to put you into the bank funds. The suite of funds that they can put you into is broader. They are licensed through the bank, but their list of funds and investments they can put you into is much broader. So roughly that would be $1,500, so all up $4,500. Or in this scenario, if you had $1 million, I'd expect that they would charge you more towards the $10,000 mark, and still that's $15,000 for the funds that they put you into. Now in this scenario, you have to understand that the advisor's not getting any of that $15,000. They only have to get the fee, that $10,000 fee. And that is due to laws that changed a few years ago. And that means that the advisor is not in any way incentivized to put you into certain funds. It's a kind of an independent type arrangement in this scenario here. So the group of other planners are the private bank planners. And private bank planners are a division of the bank that's more for the wealthier individuals in the bank. They won't deal with people with $100,000. They'll deal with people more in that $1 million category, and they'll have similar starting fees around the $10,000 upfront fee and the $15,000 for the funds that they put you into. I think when we distinguish these different types of planners, the bank planner I'd be looking at is probably more of a Honda type planner. If you think of a car as a metaphor, more like Honda. The phone planner more like a Holden. And these two here, the bank aligned and the private bank, I'd call them more Mercedes type services. Bank aligned, they're going to have their own business. They're going to want to give you a lot of care. It is their business. You'd expect that they'd be staying in that business for a long time and there for the longer term. And so when you go to them, you'd be thinking that they wouldn't be changing jobs too often, that type of thing. They'd tailor plans more to you. They'd be able to be more customized to your situation. And they'll take care in time. You'll often get their mobile phone number, that type of thing. They'll care about you, whether you're their most recent client, whether you're their first client, for example. When you go to the banks and the private bank, the private bank especially will do that care and the high touch service. Although you have to understand that they are employees of the bank, it's not their own business. So I think the care level would not be as high if we think of it logically. But they will be quite intelligent. You think banks hire intelligent people, highly qualified people, experienced people. But there is that other side of things. Is how long is that bank financial planner going to stay there? They have got strict targets around the amount of revenue they need to get in the door and the amount of money that they have to get in there too. And that's the whole idea of a bank being profit making. And so I'd expect that, 2 years, 3, 5 years, if you're lucky, that the bank would have the same planner looking after you. Of course, there's exceptions, but that's just being realistic. On the other side of things, being a bank, strong research, and a lot of people have the loyalty to the brand and get comfortable with that, the brand of the bank. The last group are independent planners, and these planners, I'd probably call them more the Rolls Royce in the sense that they have an agreement directly with ASIC. And that allows them to deal with industry super funds, retail super funds, also self-managed super funds. And I will say that also the bank aligned, the more experienced bank aligned planners and the private bank planners would deal with self-managed super funds as well. But independent planners would do so, largely in the sense that independent planners, because they deal directly with the regulator, the Australian Securities Investment Commission, they can kind of come to an agreement with what they deal with. They can use whatever funds they want, whatever products they want. They really have quite a breadth, the most independent breadth that you can have. And the other two, they're quite good too, but that's the next level, that independent planner there. The last planners I will talk about is the online planner. Online. And I think some people in the industry are looking at them kind of like what's happened with online stock brokering, how it's affected the stockbroking industry. So a lot of planners are looking at them and saying, oh, they're going to affect the planning industry. They use computer programs roughly to help invest the money in a certain way. And they're substantially cheaper in the sense that you don't pay so much that ongoing fee, and it's more of like a percentage fee. It might start at 0.8%, for example. So on $100,000, that would be $800. And then as you grow in terms of $1 million, the fee might even fall down to 0.5%. So that might be a $5,000 fee. So somewhat cheaper. Quite a different service. You think that the advisors, they're going to look at your whole situation, your whole financial plan comprehensively, pretty much hold your hand through the investment strategy, the insurance, they're going to give you referrals out to estate planners, mortgage brokers. They're really looking at, to retirement projections, what you need to save each year, and working along with you in that human interaction and communication. I actually think that online planning could be something that helps the human planners in the sense that if they get their investments being managed in a more computerized manner, that gives them more time to speak and be out there with their clients where they should be. So that's maybe the evolution in my mind, but maybe not in others in the way they think about it. Really today, this is all just general information. I'm not licensed. There's information that I hope can help you, but that's all it is. You need to seek your own advice, and there are no recommendations whatsoever in what I've just spoken about. The next video I will talk about stockbrokers, a little bit about what's happened with them and how they're remunerated and the evolution of the stockbroker. Thanks for listening.